Dear students, today we're going to look at group dynamics. Now, if your buddies jumped out of a plane, would you follow them? Well, sometimes we don't know, but guess what? When it comes to group dynamics, the world works pretty much the same way. If you just understand how people behave inside a certain group, you'll understand what decisions they're going to make and why. So, enjoy this video. You're not going to regret it. This video will look at group dynamics, market participants, agency problems, and an important part of our group dynamics around the world, and that's corporate governance, how we behave better compared to worse. Group dynamics is a system of behaviors and psychological processes occurring within a social group and even in between social groups. The study of group dynamics can be useful to understanding decision-making behavior, tracking the spread of disease in society, creating effective therapy techniques, or simply understanding why people make certain business decisions. So this video will not just look at the things that are to understand the underlying parts of racism, sexism, and other injustices, but rather look at how the fundamental decisions are done from a corporate perspective. Now, the emergence of corporate governance is changing the behavior in all these groups. We're leaving the old behind and we're moving toward a better way of working together. Sometimes that might cause a culture shock, and sometimes ethnocentrism will shine through. But by understanding the group dynamics, you have a better understanding what racism, sexism, and other forms of social prejudice and discrimination happens and how and why. So when it comes to culture, you have to start understanding your own culture first. So you have to always look at yourself first. Typically, we look at other people first because it's easier to compare the differences. But from a fundamental point of view, you need to look at you, the individual, and your immediate culture first. First of all, racism, sexism, and other types of discrimination exist everywhere in the world. There's not a corner of the world that does not have one form or another of discrimination. Now, so let's look at what is actually happening here. Well, one easy way of doing it is that describing what culture shock is. That's a shock that you have when you leave your comfort zone, your culture that you're from, and you go somewhere brand new. So assume that you're from Wisconsin and you move to Italy, or you move to Mexico, or you move to China, and they are acting and behaving in a totally different way. Their norms is different. When they eat is different. When they show up at work is different. What is legal versus what is illegal is different. Or what is ethics? There are different layers of ethics is different. So when you react to how a culture is actually behaving and you compare that with what you find familiar, and there's a gap there in between there that you can't quite bridge, that's called a culture shock. You might get all angry. You might be all frustrated and upset. You might not understand why could it be so complicated to put gasoline in your car, or how come going to the hospital operates differently. And you might not understand why you offended someone when you were just behaving perfectly polite from your point of view. Now, the inverse of culture shock is ethnocentrism. That's when we're at home in our own culture and we meet someone from a foreign land. Now, that can be New York, that can be California, that can be Florida, coming to Wisconsin, and they're behaving differently. Okay? So, it can be within a big nation like the United States. And we react with how they behave. We might find that New Yorkers are really rude. And people in Wisconsin might find people from the West Coast in California that they're really mellow. And we might find people from the southern parts of the United States lazy and slow. And maybe the worst part of all is that because they're not from Wisconsin, they are not Packer fans. How dare they? Don't they know that the Packers is the best team in football? Period. So all these things will then create some sort of rivalry. We will react to the differences in how different cultures behave when they come to visit us. And we might feel strongly against them. We might not like the way they behave. And that is called ethnocentrism. And so culture shock and ethnocentrism goes hand in hand. Now, when we look at how teams are formed, okay, so it follows a simple stepping stone where first they are formed, then they storm, then it gets normalized, and then they outperform and do fantastic. So in the beginning, when groups are formed, brand new groups, I'm talking brand new, okay? For college, it might be that you're joining the football team or you're joining another group at the school. And compared to high school, they have a slightly different culture. And you have people from all over the country going to the same school, and they all have different cultures. You will have a culture shock. There will be ethnocentrism. But in those early stages, you will know that ideas are established on a very basic level, and the expectations are outlined. That's why you have orientation week, and you'll meet other students, and so you can become friends with new students and make that process easier. And once you identify similarities, you can agree on certain things on a common goal basis. We like football. We like hamburgers. Yes, we do like the same types of television shows. And by bonding and doing things together, you build trust. And you start being dependent on each other. Now, once you go a little bit deeper into the new culture, we might have struggles on who is going to be in power, who's in charge, what are the differences in communication styles. And that's where, our emotions, it goes from, a honeymoon period of time to, feeling a little bit upset and offended, and our ideas are not taken seriously, and it hurts your feelings, and you get upset, and you get maybe even really angry and want to quit. Once you push through that, things start getting normalized. You start feeling comfortable. Everyone agrees on the work that needs to be done, the roles that are involved, and who will do what in order to solve the problems at hand. Once you move through this norming period of time, you will start performing on an amazing level. You get things done. You feel satisfied. You feel happy about meeting your new coworkers, your new friends, and everything else. And you will collaborate and get everything done that needs to be done, and you will be a power to be reckoned with. Now, groups in certain businesses typically behave very similar. So here's a look at how the financial markets look like. So looking at the market participants when it comes to the buy side of financial services, they're paid to put the money at risk for others, okay? They maximize their fees by increasing the value of their portfolio. The sell side is paid to drive the transaction volume, and they want to maximize their fees. Principal investors invest their own money, their own funds, and they want to maximize their return. Issuers of capital make money by raising capital for others. So investment banks, for example. And they are compensated that are tied to the size and the share price of these underlying companies that they're doing business for. Market makers match up buyers and sellers while charging a bid-ask spread. The more money they make, the better, and they do it when it's very volatile. The media, on the other hand, they get paid for selling eyeballs. Yes, that's The more people that is watching their media outlet, the more they can charge for their advertisement. And they love to create hypes and breaking news, and they don't need to be right. In fact, they are more focused on being first, because if they're first with information, whether it's good or bad, they believe that they can have and capture more people watching their media outlook. Look, here we have foreign exchange brokers. They buy and sell currency for a fee, but do not take a possession themselves. So they want to drive volume as well. International banks, they look for arbitrage opportunities, and they buy and sell currencies for themselves and for clients, and they try to figure out how to make extra money on that transactional cost. External banks try to influence its currency against central banks, try to influence its currency against other major currencies to put their country at a better position for international trade. Exchange traded funds promotes hot sectors, increases volume and liquidity. Okay, that's what they make money on. They also make money on assets under management. Hedge funds, they're sometimes seen as a bully, so simultaneously buy stocks, go long, while selling puts and shorting to raise additional funds to increase ownership against in certain businesses and become an activist owner in a business. Insurance companies are typically known as a big slow kids who passively invest for the long time. When I say for the long time, well, put it this way. Insurance companies like Prudential, it would take them maybe 18 months, 24 months before they can invest the premiums they receive today in a safe way, perhaps in the stock market, perhaps in real estate, and it takes a very long time for them to average in that large amount of money, and they do it with a long time perspective. Pension funds is also another really slow kid who invests money for the long term. So typically pension funds and insurance companies are the ones that get squeezed when bad things happen in the market, because they go long and they get stuck. Okay, university endowment funds, they have at least 100-year time horizon. Okay, so when they hire fund managers, they look at preserving money for the very long term, and they want the money to pay for, like an endowment for different shares at a university, so they are fully funded through investments, and just a fraction of those investments goes to paying those professors to teach. Stockbrokers, sometimes seen as candy pushers who like high volume of sales. Financial advisors, they have a fiduciary responsibility to diversify while maximizing their commissions for their clients. Now, how do we govern all these different entities? And every industry is different. I just mentioned a few different behaviors of a financial sector. Now, imagine there's a sector for all kinds of things, and they behave differently, just like that, and you need to pay attention to it. And how do we know that they behave in an ethical way? Well, we don't know. And that's why we create corporate governance policies. Now, one way of doing that is looking at corporate social governance, CSG, corporate self-regulation that is a part of the firm's business model. They just want to do good. The goal is to be both compliant with the laws of the land, plus ensure the highest ethical standards and follow international norms. Now, environmental social corporate governance is more of a catch-all term for the criteria also used in socially responsible investing. In ESG, they look at scarce resources, traditionally includes labor, land, and capital, and how you treat that in a responsible way, in a sustainable way. ESG also looks at the sustainability of these diminishing resources and say, how can we ensure that our future generations, 10 generations from now, still has the opportunity to live a decent life and pursue the happiness as they see fit. Now, when it comes to the investment side, social responsible investing has typically three main criteria to it. One is screening investments, and that's looking at positive investments and negative things that they screen away. The positive part might be looking at sustainability in manufacturing. It might be that is renewable energy and things like that. Other parts might, and fair pay. Another part where they will screen away might be the negative parts of, say, alcohol, tobacco, and firearms, maybe pornography and so on, that they will not invest in, by drying up the funds for those industries that they will perhaps go even bankrupt. Now, another part that social responsible investing engages in is community improving activities. That means that they will volunteer time and money to improve a community so that it thrives and becomes a sustainable and positive part of our societies. An example of when corporate governance went tremendously wrong was the BP oil spill, now 10 years ago. Okay, so in 2010 there was a huge oil spill that it was caused in the Gulf of Mexico. One oil well exploded, and it was because of the way the BP and their contractors were engaging in business. It has happened before in a similar way, and that was the Ixtoc 1 oil spill in 1979, 1980, that lasted about 9 months. That way, they're very similar and can be compared. Anytime you have a disaster, it's good to look at, has this happened before, and what can we learn from that old experience, and how do we solve our new situation? So, in the case of the BP oil spill, 5,000 gallons of oil was pouring out every day. That's 119 barrels, standard barrels per day. Now, that would equal, for the 9 months period of time, assuming it's 30 days flat, and that is at a rate of 119 barrels. That means that over 320,000 barrels of oil was leaking out to the Gulf of Mexico, creating a horrible environmental disaster. So what are the fines? Well, the Clean Water Act has a fine of $1,100 per barrel, while the EPA has a fine of $4,300 per barrel. So given this, the reasonable fine should probably be about $1.7 billion for all these hundreds of thousands of barrels of oil that leaked out. Now, the real expense of it was that the government at the time said this is probably going to cost the whole economy about $20 billion. Now, how was this BP oil spill punished by the financial markets? Well, given that they had about 3 billion shares outstanding at the time, and the initial stock price was $60 per share, they had a market cap of $187 billion. Now, at the bottom of this disaster, the stock price had decreased down to about $27 per share. That meant that the market punished BP by losing over $100 billion in market capitalization. So the financial markets punished them with over $100 billion. So after the stock price normalized at $40 in September of 2010, the market cap was about 125,000 or $125 billion. And so what we could say then is that the cost of the oil spill for BP and their shareholders was roughly $62 billion, plus whatever fines they had to pay. Rachel Maddow, who's a journalist on MSNBC, did a side-by-side comparison to the disaster of 1979 to that of 2010 and compared the communication in between, and it's a very interesting way how it was communicated, a long time ago in the early 80s and to that of 2010. The video is available on my playlist of great videos to watch. I recommend that you watch it and learn about this disaster. An important part when you have a disaster is to have a plan. You need to get the information fast. You need to get it correct. You need to communicate it out as soon as you can, and it needs to be flawless. And then you have to get the crisis over with. So how do we end up with these conflict of interests where profits versus doing the right thing might conflict with each other? And that has to do with the remedies of agency problems. One, we have the legal part of things. That's a bare minimum. What is legal and what's illegal? Now, corporate governance is trying to add a layer of ethics on top of what is legal to make sure that we do not behave in a bad, irrational way. That means that there has to be consequences of law, and there needs to be a movement of corporate governance reform. And that comes from the ownership of shareholders saying that no, board of directors and executives, you may not go wild with my money at all. Because if you don't vote your proxies and don't tell the corporation who you elect as your board of directors and whether or not you will hold the business leaders accountable, then they will go wild. You simply throw the car keys to them and a credit card and assume that they are irresponsible teenagers. Guess what? They will go wild. And that's why it's important to make sure that when you are a shareholder, you vote your proxies and make sure that you only invest in companies that do listen to what the shareholders are saying, but also making sure that you have portfolio managers that are actually on your side, that are active portfolio managers that engage in shareholder activism. That's just being an adult and doing the right thing. Because the biggest weakness is between the conflict of the interest between managers and the shareholders. The shareholders naturally want to have more dividends and an increased share price. Now managers, and here I'm saying and really pointing out it's really the executives, but the ones that are actually managing the business are looking at how can they line their pockets with as much money as they can that enables them to do these unethical things. So as a shareholder, you have the right to vote for who should be the board of directors. Okay, the board of directors indirectly hire and fire the executives who operate the company. The management, typically the corporate boards are management friendly and they're dominated by insiders, and they don't want to rock the boat because they totally like the perks that they have, and therefore they might turn a blind eye. That's why you as a shareholder need to pay attention to those things and fire the board members if they don't behave correctly. Now, different cultures have solved things differently. In England, they have something they call the Code of Best Practice, and that is a part of what they call corporate governance. In Germany, on the other hand, the board is really a representative not only for the shareholders, but also representing the greater interest of the stakeholders as a whole. And typically the Germanic countries, if the company files for Chapter 7 or Chapter 11 bankruptcy protection of some sort, they are not eligible to be on the board or directors for a business for a period of time of 5 years. Same thing goes for the executives. They lose the right to be an executive, and that means that they lose their livelihood. If they lose their livelihood, then what happens? Well, they will behave in an ethical, sane way of life. They will not take stupid risks. So how do executives get aligned with the incentives that the company is trying to put forth? Well, it used to be that it was more focused on the sales, a combination of sales and net income, that there was a combination there, that's how they focused on stuff, and making sure the business was doing great. Now, the sales might not be pushed as hard if they only need to do the following, which is that they need to use net income to buy back stocks so that their options become in the money and they make money that way. That way, there's a lot of creative accounting that happens when a business is not doing so well. When it came to Arthur Andersen and their involvement in Enron, the executives at Enron had the employees buy shares from them. So they had a bunch of stock options, and they were selling the shares to the employees. They were more or less forced to do it through their 401k program, and that made the executives extremely rich. Okay, they were given low-priced options, and they were in the money fast, and then they sold those this underlying stock that they had to the shareholders in a way that pushed up the stock price, and that lasted until there was total collapse in that company. So watch a movie or documentary on Arthur Andersen and their involvement in Enron, because that caused a huge problem, and it was similar when it came to WorldCom as well. Yet we still focus on stock options as a way to motivate people in corporations to work hard and dedicate their life to take risk and work and achieve the goals of the company to make shareholders money. Also, very often are executive stock options given with a huge tax break. Okay, they're almost given like grants of at the money options that are considerable as taxable income, unless they have the money to buy the underlying stock, in which it becomes long-term capital gain. Now, in the United States, we have very strong protection for the issuers of capital and the investors, but that doesn't mean that bad things can't happen. But in some countries, they're really weak investor protection, and that could be result in less than positive returns when bad things happen. So there's a very fine line between very good returns and no returns at all, and that has to be weighed in onto the ethical part of life. Now, when it comes to finance, you need to have strong, well-defined laws when it comes to protecting people's investments, because it enhances savings for the future. It channels savings to not only real estate development, but also into rewarding businesses that do behave properly to create new jobs. And it makes the asset allocation of funds better. The United States of America probably has the strictest capital market in the world when it comes to rules, regulation, compliance, and all those other things. It becomes very expensive to be in the financial services world, but then again, it's a protected way of protecting cash, money, investments, and that's why other countries are sending their hard-earned money to the United States, because we have such a stable and good market. Are we perfect? No, we're not, but we're getting there one day at a time. Dear students, I hope you enjoyed this video. If you did, give me and like the page. That way all of these followers like you will get the latest and greatest of my uploads. Not only that, at some point you can help me help you by having a much nicer URL, instead of having that really weird one that you can't really remember anyway. So if you do that, I will be really, really thankful, and I'm here for you, okay? So help me help you do better in life. Thank you very much.